This week on Wealth Track, picking the perfect portfolio potion for earnings and dividend growth. Nuveen star strategist and large cap funds manager Bob Dahl shares his formulas for long-term outperformance. Next on Consuelo Mack Wealth Track. The large cap universe, a lot of people will say, look, you're better off in an index fund in the large cap universe because it's a well-known universe, kind of everybody owns it. That's where Wall Street does its own research. What's your response to that?
It is well-mined, there is no question about it. It is a very efficient part of the capital markets. Right. Having said that, the first place I usually go when somebody challenges me is like, here's the track record in the products that we manage. We've outperformed. Not all the time, but most of the time, and more importantly, over time.
Right.
So there's some evidence that if you have a process, a discipline that makes sense, and you stick to it, and you get up a little earlier, and you work a little bit harder, you can win. Now, the average active manager in the last few years, has not done a very good job. And so the money has moved in a passive direction. The monkey's on the back of we active folks. We've got to show the numbers to get the money back. If we don't, shame on us.
The market capitalization model, which is that basically you continue to pay up for the most expensive stock. The more valuable the stock, the bigger its position in an index. Is that a problem?
It can be. Stocks get more expensive, they become bigger in the index.
Right.
And you're going to own more of it. Well, wait a minute. I think I want to buy them when they're cheap, not when they're expensive.
Therefore, so an Apple, you're owning it too. Does that make you an index hugger? Your active share, something that we've talked about in Wealth Track before, is pretty high, right?
Correct. Our active share runs 75 to 80 across our products on average.
And active share means how you differentiate yourself from the index.
Correct.
That's your benchmark. So the Russell 1000 in your case,
That's right. So another way to look at it is what do you own versus what don't you own?
Right.
The index owns them all. We happen to like companies that have strong unit growth and don't need pricing power. Healthcare, technology. We don't like companies that require pricing power. Energy and materials. There's an investment bet that we are making relative to the benchmark.
Right.
If you don't do a little homework and try to figure that out, you're stuck owning healthcare, technology, materials, and energy in the proportion of the market. And, I think you can do a little better than that with a little bit of homework.
Bob, what kind of pressure are you under as a portfolio manager to match or to beat the benchmark?
Having done it over 30 years,
right.
There are many periods where I've underperformed, and you look in the mirrors, have I lost it? What's the matter? Has this gone off the tracks? That's when it's tempting to say, you know what, let's change our discipline. But that's the exact time, most likely, when you want to dig in and dig deeper and stick to what got you there.
Right.
And so the answer to the question is, I think part of being a good investor is being a disciplined investor. Doesn't mean you don't listen to the market. The market's right, you're not. But the process needs to make sense and be stuck to over time.
What does a long-short fund do in a portfolio? Most of us have long-only portfolios.
Yes.
Why are you running these alternative equity funds, the long-short fund, for instance?
What they give investors is more bang for the buck, if you will. If you put $1 in a long-only fund, you've got $1 working for you. If you use a long-short fund, now you have the long side and the short side working for you. I like to say I have 17 fundamental research analysts. And they go about their business and they analyze companies and they come back and they say, I looked at these 6 companies, 3 we like, 3 we don't. In a long-only portfolio, you take the 3 you don't, you throw it in the trash can.
Right.
If you have a long-short portfolio, if the analyst is any good, now we can make some money on this side and some money on this side for our investors.